Good afternoon. Thank you so much. Thank you all so much for coming again to our presentation. My name is Christian Dawson. I'm one of the undergraduate advisors in the Department of Economics. Do we have any newly admitted bears in the house? Congratulations, let's give them a hand. We are here for you all. So I will be introducing one of our economics faculty members, Professor Gabriel Zucman. He will be presenting the faculty spotlight on globalization, taxes, and inequality. Gabriel Zucman is an assistant professor of economics at the University of California, Berkeley. His research focuses on the accumulation, distribution, and preservation of wealth in a global and historical perspective. Professor Zucman's research papers have been published in the Quarterly Journal of Economics, American Economic Review, and Journal of Public Economics, among other outlets. He is the author of The Hidden Wealth of Nations, The Scourge of Tax Havens, which has been translated into 18 languages. Professor Zucman recently was awarded as an Alfred P. Sloan Research Fellow, which brings the Department of Economics to 31 faculty fellows, so congratulations. Please join me in welcoming Professor Zucman.
Thanks. Thank you so much. Thanks for being here. It's a great pleasure to talk a little bit about my research. I should stress that feel free to ask questions, during the talk so that we can make that interactive and maybe as fun as it could be. The starting point of my remarks is that globalization has created new ways to avoid or to evade taxes. So for instance, multinational companies can shift profits to low or zero tax places. In 2017, for instance, Google, Alphabet, one of the biggest companies on the planet, has made $20 billion in revenue in Bermuda, a small island in the Atlantic where the corporate tax rate is a modest tax rate of 0%. And they are not the only ones to do that. Firms in all sectors of the economy, in tech, but also in finance, in the pharmaceutical industry, in manufacturing, do that. So they book their profits where taxes are low. There are problems too with individuals, wealthy people who can conceal assets, wealth, in places that traditionally had strict bank secrecy laws, like Switzerland. So that's tax evasion by rich, some wealthy individuals. So for instance, Paul Manafort, the former Trump campaign director, was found guilty of hiding millions in income that he had earned on his bank accounts in Cyprus and earning income that was not reported to the US tax authority. And so the question that I'd like to address today is the following question. How do these various forms of tax avoidance and tax evasion that have been made possible by globalization, how do they affect inequality? Both the inequality across social groups and inequality between countries. And that's an important question if we want to think about the sustainability of globalization. So basically, if globalization means ever lower and lower taxes for those who benefit most from it, like big multinational companies or very rich people, and ever higher and higher taxes for those who don't benefit much from it, like the working class or small businesses, then it's unlikely that it has a very bright future. That's not very sustainable. And this is not to say that globalization, has no future. It does have a future if we think hard about what types of policies, and in particular tax policy, and what types of regulation can make it sustainable, can ensure that those who benefit most from it, instead of paying less and less, actually pay more. And those who don't benefit from it, instead of paying more, actually pay less in tax. So the starting point is this graph, which I think summarizes well what has happened in the US in terms of rising inequality. That's maybe the most comprehensive and shocking way to summarize the changes in the income distribution in the United States over the last 4 decades. So that's a graph that shows the fraction of total US national income that goes to the top 1% highest income earners. So that's the black line, that's rising. And the fraction of total US national income that goes to the bottom 50% income earners. Okay, so half of the population. And that's the white line. And what's striking first is that these two lines, fit on just the same axis. It's the same axis for the top 1%, the bottom 50%. By definition, the bottom 50% is 50 times larger than the top 1%. Second, what's striking is to see that the two groups basically have switched their income shares opposite. So in the late 1970s, the top 1% earned about 12% of total US national income. Now it earns about 20% of total US national income. In the late 1970s, the working class, the bottom 50%, earned about 20% of total US national income, and now it earns about 12%. So it's exactly the mirror image of what has happened at the top. So if you want, the gains made at the top have been so enormous, the gains made by just 1% of the population have been so enormous that they would have been enough to compensate the losses that have been made by half of the population, by the bottom 50% of the income distribution. So that's a huge change in income inequality in the US. That's fact number one. Fact number two is that at the same time as this inequality of pre-tax income increased, the tax system has become much less progressive. And so the tax rates, very concretely, for the wealthy have declined a lot, while the tax rates for the rest of the population have tended to increase. So that's a graph that shows the evolution of the average tax rate for two groups of the population. The very rich, the top 0.1% on top, and the bottom 90% of the population at the bottom. So today, both groups of the population pay about 30% of their income in tax. The very, very rich have an effective average tax rate that's a bit higher than the average effective tax rate for the broad middle class, but they're almost the same tax rates today. In the past, it used to be very different. So the United States has a long tradition of actually taxing the wealthy at very high rates. In the post-World War II decades, the average tax rate for the top 0.1% was 50, as much as 60%. So that for every dollar earned in income by these very rich Americans, 50 cents or 60 cents went straight to the IRS. And the tax rate for the middle class was much lower than it is today. It was 15, 20%. What has happened since then is that taxes for the middle class have increased, mostly because of the rise in payroll taxes. And taxes for the very wealthy have declined dramatically. And so the question is why? Why have the taxes for the very rich declined? So this graph decomposes the taxes paid by the very rich, the top 0.1% highest income earners in the US, by type of tax. So this graph, the top line is just the same as the black line here. That's the evolution of the total tax rate, taking all taxes into account for the richest Americans over time. But here I'm showing you the contribution of each tax. So very rich people don't pay a lot in sales taxes relative to their income because they don't consume a lot relative to their income. And also because in the US, sales taxes are only on goods, not on services. And the rich, they mostly consume services. If you buy opera tickets, for instance, there's no sales tax. If you buy appliances or clothes or meals, sales taxes apply. In any case, for the wealthy, sales taxes are very small. What was big historically and what has declined enormously over time is the corporate income tax. So that's something that's really important to understand. If you want to understand the big decline in progressive taxation, in the average tax rate of the wealthy, almost all of the action comes from the decline in corporate taxation. Why? What's the link between corporate taxation and the tax rate of the wealthy? Is because, at the end of the day, all taxes are paid by real people. It would be great if we could make big companies or robots or other countries pay taxes for us, but that's not possible. All the taxes are paid by flesh and blood individuals, and corporate taxes in particular, they are paid by the owners of corporations. If you own a company and the company has to pay the corporate tax, it means the company can pay less dividends to its shareholders, or it can reinvest, it can save less of its earnings. And so in both cases, that reduces the true income of shareholders. Now, in the middle of the 20th century, the corporate income tax was big. It collected a lot of tax revenue. At some point, it was almost as big in the early 1950s as the individual income tax. Corporations in the United States were taxed at 50% on average. So for any dollar of profit, corporations in the US in the 1950s paid 50 cents to the IRS. The effective tax rate was 50%. And because the ownership of corporations is very concentrated, equity ownership is very concentrated and was very concentrated in the middle of the 20th century. These high corporate tax rates meant that in practice, rich people, through the companies they owned, paid a lot of tax. Okay, so that's why the tax rates were so high in the middle of the 20th century for the wealthy. And then you've had this collapse in corporate taxation. So the last dot, for 2018 is the effect of the Trump tax reform that slashed the corporate income tax rate from 35% to 21%. But the big decline had started much before that. Had started in the 1970s, accelerated in the 1980s, in the 1990s, and so on. And so that's why if you care about tax justice and the fair taxation of the very wealthy, and if you want to care about inequality, you need to think about corporate taxation. Imagine you want to, reverse this trend, stop the rise of the top 1% and put an end to the decline in the bottom 50%. Taxation is a very powerful tool, historically, to affect the distribution of income, but the tax rates have declined a lot for rich people. So how can we change that dynamic? And before changing that policy, tax policy, we must understand why corporate taxation has declined so much. And so to understand that, you need to think about what has happened to tax avoidance by multinational companies and to tax competition. So in particular, one big question is, can we compute what fraction of this big decline in the corporate income tax paid by the wealthy, what fraction of this comes from pure tax avoidance by big multinational companies? So globally, if you take the planet as a whole, how much profit do multinational companies shift to low-tax countries, like in the Google Alphabet example that I mentioned at the beginning? What's the total amount of profit that in a given year is recorded by US firms or by German firms in places like Bermuda or Ireland or the Cayman Islands and so on? So that's one question. And the other question is it because firms are moving their profits to tax havens that tax rates are falling so much? Or is it because they are moving real production? They are moving factories. They are moving headquarters. They are moving plants and workers along the way. So what is more important? On one hand, you have something which is, you could call pure tax evasion. I'm a big company. I make profits in the US by employing US workers and selling products to US customers, but I find ways to pretend that my profits have been made in Bermuda, where the tax rate is 0%. So that's profit shifting, that's tax evasion, that's artificial. How big is that? Versus how big is the other way for firms to avoid taxes, which is let me move my production, my factories, my workers, my headquarters to Ireland or to Singapore or to low-tax places more generally. And so the way to think about these questions is you can run the following thought experiment. Imagine that there was a perfect international tax coordination, that all countries had the exact same corporate income tax rate. So no Bermuda with 0%, no Ireland with 12.5%. Everybody has the same rate. Let's say every country has a 30% tax rate on corporations. In such a world, by how much the profits booked and taxed in the US would increase as compared to today's situation? And how much Ireland or Bermuda or today's low-tax countries would lose as compared to today's situation? And if the US wins, is it because there would be less profit shifting out of the US to Bermuda, or is it because there would be more capital, more factories, more headquarters in the US and less in low-tax countries? So I'm going to try to provide some statistics about that, but before I discuss the statistics, just a brief reminder about how multinational companies can can artificially shift profits, book earnings in low-tax places. How does that work in practice? How is it possible for Google Alphabet to say that they made $20 billion in revenue in Bermuda? How does that work in practice? So there are several ways that multinational firms can do this. One way is, let's say I'm a US automaker and I have a plant, I have a subsidiary in Ireland. I import cars from Ireland to the US. I can manipulate the price of these intra-group transactions. So for instance, because the corporate tax rate is higher in the US, I can import from my own subsidiary in Ireland cars at an artificially high price. That's going to be a cost for the US, that's going to reduce the tax base in the US, that's going to reduce the amount of tax I have to pay in the US, and that's going to increase profits in Ireland, that's going to increase the tax base in Ireland, that's going to increase how much taxes I have to pay in Ireland, but because the tax rate in Ireland is much less than in the US, for the company as a whole, it's better off by manipulating these intra-group transfer prices. So that's one way. The other way is I'm a US company, I can borrow money from one of my very own affiliates in Luxembourg, for instance, and I'm going to pay interest to my affiliate in Luxembourg. And because interest can be deducted from the corporate income tax base in the US, that's going to reduce how much profits I have to report in the US, how much tax I pay in the US. And same thing, that's going to increase the tax base in Luxembourg where the tax rate is much lower. And then there's the case of Google Alphabet, where just a few months before being listed as a public company in 2004, they sold some of their intellectual property, algorithms and patents, to their own subsidiary in Bermuda. And we don't know the price of this sale, is not public information, but in practice there are ways to guess that it was at a very low price. But they sold their very valuable intellectual property to their Bermuda company, subsidiary. Now the Bermuda subsidiary since 2004 has been the legal owner of these patents, and so it licenses the right for all the Google affiliates all over the world, the right to use this intellectual property. And in exchange for granting that right, it charges royalties to Google Germany or to Google UK or Google France. And so all the affiliates of Google all over the world pay royalties to Google Bermuda. These royalty payments, they reduce the tax base in high tax countries in Europe. They increase the tax base in Bermuda, but because the tax rate is 0%, that means a big tax reduction for Google as a whole. Okay, so for a long time, all of this was well known, but what was not very well known was how big is this in terms of magnitude? Is it just a few case stories like Google Alphabet, or is it more comprehensive? And what are the costs for the various governments all over the world? And so what has happened is that recently there's been some progress, some statistical progress, because countries have started compiling and publishing new statistics, which are known as foreign affiliate statistics, that record the total amount of profits and taxes paid by foreign firms. So for instance, for a long time, take a country like Ireland. For a long time, Ireland, the only data that they published was for Ireland as a whole, here is how much profits Irish companies make, and here is how much they pay in wages to their employees. Now, what we know, thanks to this new data, is in Ireland, here is how much profits foreign firms make, so subsidiaries of Google, of US companies, or subsidiaries of German companies, how much profits they make in Ireland, how much wages they pay, and for Irish companies owned by Irish people, so not subsidiaries of foreign companies, how much profits they make, how much wages they pay. So now we can use this to compute a very simple statistic. So the computation I'm going to show you is really simple. I'm going to take, let's say, a country like Ireland, and I'm going to compare how profitable affiliates of foreign firms are, how profitable subsidiaries of US multinational companies or subsidiaries of German companies are, as compared by Irish firms. So there are firms that are in the same country. The only difference is one type of firm is owned by a foreign parent, and the other type of firm is a standalone company. So let me start not with Ireland, but let me start with, and before mentioning that, so the way that we're going to measure profitability is just with a very simple computation. It's just dividing the amount of profits made by firms by the amount of wages that they pay to their workers. So this means, if you're very profitable, this statistic is going to be very high. For $1 of wage, you make a ton of profits. And if you're not very profitable, then this statistic is going to be low. So starting with not the tax havens, but the high tax countries, what this graph shows is this statistics of profits divided by wages for the main G7, G8 economies, and separately for local firms versus foreign firms. So what this means is that if you take a country like Germany, and if you look at local companies in Germany, so firms that are not affiliates of foreign multinationals, but German firms in Germany, they are quite profitable in the sense that for any euro of wage paid to their workers, they make about 50 cents in profits. Okay? But now if you look at the pink bar here, you see that foreign firms, so for instance, subsidiaries, for, let's say Apple Germany, that's a foreign firm for Germany, it's an affiliate of a US multinational that operates in Germany. These foreign firms in Germany appear to be very unprofitable. Okay, for any dollar of wage made, they make 20 cents in profits. And generally speaking, in high tax countries, it's always the case that foreign firms look in the data much less profitable than local firms. Now, that was for high tax countries. Now, they are still here, and I'm adding on the left part low tax countries, the tax havens. And in the low tax countries, in the tax havens, it's exactly the opposite. So now you look at Ireland, for instance. Ireland, the local Irish firms, are about as profitable as in Italy or in Germany or in the UK. For any dollar paid in wage, they make 50 cents in profits. But for the foreign firms, the Apple subsidiaries in Ireland, the Google subsidiaries in Ireland, Goldman Sachs subsidiaries in Ireland, if they have one, they are hugely profitable. So for $1 of wage paid, they say, oh, we make $8 in profit. In Puerto Rico, for $1 of wage paid, we make almost $17 in profit. Luxembourg, for any dollar of wage paid, we make $6 in profits. So that tells you basically that in countries where taxes are high, multinational companies, they try to strip earnings out of these countries. So that's why the pink bar is lower than the black bar. But these earnings that are stripped out of the high tax countries, where do they show up? They show up in the low tax countries. And so from that, when you have a figure like that, it becomes very easy to estimate how much profit globally is shifted to tax havens. The computation is, if all countries had the same corporate tax rate, presumably what would happen is that in each country, the pink bar would be the same as the black bar. Foreign firms would be about as profitable as local firms. And so if you make that computation, if you equate within each country the pink bar to the black bar, if you interpret all the excess, the excess of profitability in foreign firms as reflecting profit shifting, tax evasion by multinational companies, then you get an estimate which is that about $600 billion today in global profit are shifted to tax havens. $600 billion, that's basically the excess of the pink bar over the black bar in all these low tax countries. $600 billion, that's the equivalent of 40% of global multinational profits. Multinational profits, these are the profits that are made by companies outside of the country where they are headquartered. So the multinational profits for Apple, these are all the profits made by Apple outside of the US. What I'm saying is that out of that total, this global total, 40%, almost half of these profits, end up being booked and recorded and taxed in very low tax countries like Bermuda, like Ireland, and so on. And if you look at which countries lose tax revenue because of that, if you try to track the origin of these profits that end up in Ireland or in Puerto Rico or in the Cayman Islands, here is what you see. What we find is that about a third of this total of $600 billion comes from, in the first place, from high-tax European Union countries. About 20% 25–30% comes from the US and is shifted to Puerto Rico, or is shifted to Bermuda, or to the Cayman Islands. About a bit more than 20% come from developing countries, and the rest from the rest of the OECD. So the point is that every country, every at least high-tax country or non-haven country loses profits, and so loses tax revenue because of this form of tax evasion. But the number one loser, quantitatively speaking, appears to be the European Union or the high-tax EU countries. So you could do another computation, which is instead of looking at which countries lose profit and lose tax revenue, you could ask which multinationals are more likely to use tax havens. So if we trace the 600 billion, these profits here, if we try to trace them back to the country not where they've been made in the first place because the customers are, but to the country where the parent company is incorporated, what do we see? If we do that, that's the blue bar here. If we do that, what we find is that about half of the 600 billion in globally shifted profits ultimately accrues to the US. That means these are profits that are shifted by US multinational companies to low-tax countries. About 25% comes from EU multinationals, I don't know, Volkswagen or L'Oreal or Nestle, about 10% for developing countries, and the rest from the rest of the OECD. So if you want, the pink bar is who loses profits, and the blue bar is who are the main offenders, in the sense of which multinationals are more likely to use tax havens to slash their tax bill. And so it seems that US multinationals are slightly more aggressive when it comes to using tax havens than multinationals from other countries. But all multinationals do it, right? The EU multinationals do it as well. Developing countries have relatively few multinationals as compared to the US and the EU. But every country steals a bit of tax revenue from other countries. Okay, so the thing that's striking is US multinationals seem to shift a lot of profit. Now the question is, okay, what's going on? What's so special about US multinationals? And so in particular, when has this profit shifting started? All the figures that I've showed so far were for recent years, so 2015, 2016, when the latest available data. But now I want to understand when this has happened. If we want to think about what type of policies are behind that, I want to think about when has this profit shifting developed. And so let me start. So now I'm looking at just US multinational companies. And I'm looking at their foreign operations outside of the US. And here I'm looking at where they employ people. I'm dividing the rest of the world into two groups: low-tax countries, tax havens where corporate tax rates are very low. That includes Ireland, that includes Singapore, Hong Kong, Switzerland, Luxembourg, and so on. And the rest is the medium or high-tax countries like Canada, UK, Germany, Mexico, China, Japan. And so what you can see is that all the way over the last 50 years, US companies have employed about 5 to 10% of their workers in subsidiaries in tax havens, so in Ireland and places like that. And about 90 to 95% of their employment, as measured by the wages that they pay, has been in medium or high tax countries. So it's not the case that production, or at least that workers, have moved to low tax places. Okay, so that's still the bulk of production is in high tax countries. Now I'm adding not only wages but capital. Where are the machines, the plants, the equipment, the buildings that US multinationals have abroad? And it's broadly speaking, it's the same thing. This capital stock, only 15% is in low tax countries. 85% is in high tax countries. So the capital, it's not the case that capital, that machines, equipment, and factories have moved massively to low tax places. Globalization has not been this. That's not what has happened. What has happened is this, is the profits have moved to low tax countries. Okay, so that's very important. So today, there's a problem on that axis, but yeah, sorry. But basically, that is 2016. And in 2016, half of all the profits made abroad by US companies have been booked in tax haven subsidiaries, in low tax places, and the other half in high tax places here. So globalization has not been capital or employment moving to low tax places. That would be, if you want, legal tax avoidance. That would be machines moving to where taxes are low. No, that's not this. Machines and workers are still in high tax countries, but paper profits, again, like in the Google Bermuda example, almost nobody works for Alphabet in Bermuda, but they book a ton of profits in Bermuda. And so that basic idea, that's true not only for a company like Google Alphabet, but that's true broadly speaking when you look at comprehensive statistics about US multinational companies. Now, sometimes when I show that graph, people say, oh, no, it's very misleading because maybe what has happened is, because here it's just tangible capital, it's just machines, it's just buildings. Maybe what has happened is that intangible capital, patents and logos and research and development now are created actually in low tax places. But that's not true. You look at the number of people engaged in R&D, and is it the case that Alphabet is producing its algorithms and its intangibles in Bermuda? No, primarily they are producing this here in the US, and to the extent that they employ people outside of the US, they're in London, they're in Berlin, in Paris, or in Tokyo, but they are not in Dublin, they are not in Grand Cayman, and they are not in Bermuda. So paper profits have moved to tax havens. Capital and employment has not moved to tax havens. One way to summarize all of this is this graph here that shows on the x-axis what's the effective foreign corporate tax rate for US multinationals. So for instance, in India, US multinationals for $1 of profits made in India have paid a bit more than 30 cents, a 30% effective tax rate, to the Indian government. That's effective tax rates, taxes paid divided by pre-tax profits on the x-axis. And on the y-axis is the measure of profitability that I discussed earlier, which is profits divided by wage. So when you have a very high profits to wage ratio, it means you're super profitable. You're booking a lot of profit in that particular place, in that particular subsidiary. And as you can see, the correlation is pretty striking, right? So where taxes are low, effective tax rate less than 10%, that's where profitability is huge. So in Ireland, US multinationals, for $1 of wage paid, they say we make $8 in pre-tax profits. And that's precisely because the corporate tax rate in Ireland is so low. In the countries where tax rates are higher than that, multinationals book very little profits. And so you are in a situation today where about half of all the foreign profits of all multinational companies have been booked in just Singapore, Netherlands, Switzerland, Bermuda and Caribbean tax havens like the Cayman Islands, and Ireland. Half of all the foreign profits of US multinationals. These foreign profits are taxed, these profits in those countries here are taxed on average at 7% by these foreign governments. These profits here are taxed on average at 27%. And so basically that's the situation today for US multinationals. All right, so that is one aspect of how tax avoidance, tax evasion redistributes income. It redistributes profits across countries and tax bases across countries. But that's only part of the story. The more important part of the story, in many ways, is that tax avoidance redistributes income across social groups. That was the beginning of my remarks. Who benefits from the big decline in corporate taxation, from all these profits being taxed at a very low rate? That's primarily the shareholders of multinational firms. And who are these shareholders? They tend to be relatively wealthy. And so in ongoing work with two of my Berkeley colleagues, Cécile Gobert and Will Senholz, we are trying to estimate how much the various social groups in each country have gained or lost from tax competition, from the fact that some countries apply much lower tax rates than others, which gives incentives to companies to book profits in those places. So there is redistribution across social groups, and there is also some redistribution across countries, which is interesting to think about if we want to think about potential solutions. So when redistribution between countries means very concretely that the small, low-tax countries that offer very low tax rates, that's actually a very good strategy for them in the sense that it enables them to collect a lot of tax revenue. So that's something that's not totally intuitive, right? If you have very low tax rates, how can you collect a lot of tax revenue? So before explaining this, just look at the graph here. Malta, which is a small tax haven in the European Union, is the country in the world that has the largest corporate income tax revenue relative to their national income. 8% of national income they collect in corporate income tax revenue, despite having a very, very low tax rate. Luxembourg is number 2. Hong Kong is number 3. Cyprus, these are all low, very low tax countries, and they collect a ton of tax revenue. And the high tax countries here, so that's for 2016 when the US tax rate was still 35%. Germany has a high tax rate, Spain, Italy. So the high tax countries are among the countries that collect the smallest amount of tax revenue. So you might say, well, this is great. That means if you cut taxes, it increases tax revenue. It's like in the Laffer curve. That's what right-wing people sometimes like to say. You slash taxes, and it's wonderful. It's going to increase tax revenue. Yes, perhaps if you're a very small country and you do that, but you're doing this, it's exactly at the expense of other countries. For the world as a whole, it's pure zero sum. Okay, it's not creating anything from the viewpoint of the planet as a whole. What's happening is that Malta chooses a very low tax rate, and so now multinationals, instead of booking profits in the US or in Germany, are going to say, oh, we've made a lot of profits in Malta. That reduces tax revenue in the US, in Germany, and increases tax revenue in Malta, one for one. This is pure robbery, basically. That's not increasing, that's not adding anything for the planet as a whole. But that's from the viewpoint of a small country, that's a very profitable strategy, because if you're very small, you can attract a ton of profits compared to your domestic business sector. And so by applying a tiny rate, you're going to be able to generate a lot of tax revenue. The US could not do that. If the US tried to become like Malta with a very, very low corporate income tax rate, the US could attract a bit of, some profit from the rest of the world, but it would also lose a lot because it would tax much less the big domestic business sector. So it's a strategy that only works for very small countries, but for them, it works very well. Let me just show you the case of Ireland. This is showing basically the evolution of profit shifting in Ireland, in the sense that this is showing our metric of profitability for the country as a whole, how much profits are booked in Ireland as a fraction of the wages paid by Ireland to workers. So when this jumps like that, for instance, in 2015, it jumps like crazy, that's because some multinationals, typically US multinationals, start booking a lot more profits in Ireland without moving any workers or any real production to Ireland. So that tells you the evolution of profit shifting in Ireland. So more and more profits are shifted to Ireland. But that's the funny thing. As profit shifting rose, tax collection rose in Ireland. So in the 1970s, the US collected more corporate income tax revenue as a fraction of its national income than Ireland. But today, that's the opposite. Ireland collects more than the US, and Ireland collects more with a much smaller tax rate. Ireland has a 12.5% nominal tax rate. So on the right axis here, you have the nominal corporate tax rate in Ireland. It used to be 50% in the 70s, cut it to 12.5%. When it was 50%, they collected very little tax revenue, 2% of national income here on the left axis, that curve. And as they cut it, tax revenue actually increased. So that's a striking illustration of how, if you are a relatively small economy in a globalized world, you can gain a lot in tax revenue by slashing your rate and basically siphoning off the tax base of other countries. And so when you see that, there are two potential reactions, at least. One, and for a long time that was my reaction, was, okay, we're doomed. We are doomed because countries like that, they gain so much by doing this that there's nothing that can be done to convince them to increase their tax rate, to convince them to coordinate their tax policy with other countries, to convince them to be more cooperative. And so we are doomed. More and more countries are going to offer very low tax rates. Firms are going to shift profits to these countries. The corporate tax is going to die. And effective tax rates at the top of the income distribution are going to keep falling. And inequality is going to keep rising. That's what I thought for a long time. But then I thought, OK, can we think of potential solutions to this problem? Okay, is it really the case that we can't do anything to prevent this from happening? And so I'm going to basically finish with that. There's actually several ways that you could address that problem. But one thing which is absolutely true is that there are ways to tax corporate profits at high rates, even when you have tax havens that offer very low rates, and even when multinationals shift a lot of their profits to tax havens. One such possibility is to do what US states already do. So you know that a state like California, for instance, to determine how much profits have been made in California and are taxable in California, what they do is they look at the profits made by Coca-Cola, for instance, throughout the US, at the US level, and they say if Coca-Cola has made 10% of its US sales in California, we are going to consider that 10% of their US profits have been made in California, and that's what we're going to tax. And you see that countries could actually do that, not only states within the US, but any country, let's say, France could say, if Apple has made 10% of their global sales in France, we are going to consider that 10% of their worldwide, their global profits, have been made in France, and that's what's going to be taxed. And the beauty of this is it's very easy to move profits to Bermuda, but try moving your customers to Bermuda. That's going to be harder. The customers, they are in the US, they are in France, in Germany. And the second beauty of this is you don't need the approval or the agreement of anybody. Ireland doesn't have its say, in the Cayman Islands neither. Any country can say that's going to be the way that we're going to compute the tax base in our country looking forward. And so this illustrates a very simple but important point, which is that globalization and capital taxation can be made compatible. You can tax corporate profits at high rates, maybe 30% or 40%, even with little international coordination. Now, international coordination is always better, and I'm not going to have the time to talk about that today. But I just wanted to say, even if you have a very pessimistic view about the prospects for more international coordination, and I think most of the time people are too pessimistic. But even if you're very pessimistic, there are concrete and tested solutions to the problem of tax competition and profit shifting. So my conclusion is there's been a lot of attention that's been paid to the redistributive effect of international trade. There's a ton of work in economics, and that's very important. When you look at trade, and although some of that is unraveling today, but in the long run, if you look at trade, we've made huge progress in coordinating our trade policies, reducing trade barriers, harmonizing rules, and mostly it's a good thing. But when you look at taxes, there's been none of that. So globalization so far has been without any serious attempt at harmonizing corporate taxation, for instance. Any serious attempt at tax coordination. It's also, there's been too little that's been done to fight financial opacity, tax competition, and profit shifting. And so my conclusion is I think we economists, and I hope you or some of you, we should spend more time trying to think about solutions to these problems. How can we achieve more international coordination? How can we ensure that we're going to be able to tax the big winners of globalization in the future? Because if we don't, I think we run into serious trouble. But my conclusion is optimistic. Is I think there are concrete solutions to the problems that I mentioned. Thank you very much.
Thank you so much, Professor Zucman. We have a few more minutes, so if we have a couple questions, I'll bring the mic over.
Isn't it true that there's some progress that's being made internationally? Isn't the European Union starting to tax based on sales made in the region?
Yeah, that's a great question. So there is some evolution. So the main evolution is that some EU countries, the UK and now France, are trying to tax big companies in the digital economy. So they've just introduced a tax on the global sales of digital companies, which is not necessarily a great idea. It's different than what I was describing. What I was describing was taxing profits, but allocating profits based on where sales are made, which is different, which means that if you don't make any profit, you don't pay any tax. If you tax sales directly, you're always going to pay taxes even if you don't make profit. That's one problem. And the other problem is there's no reason to just target the digital industry. I like to take the example of Alphabet because it is correct that they are among the worst, this industry among the worst offenders, but they are far from the only ones. And so just addressing profit shifting for the digital industry and doing nothing for finance or for pharmaceutical or manufacturing. Nike also has its logo in Bermuda and is also charging royalties to its subsidiaries all over the world. Why just address what's maybe 10 or 15% of the problem and not 100% of the problem?
Hey, thank you so much for the lecture. What is kind of your answer to re-HQing? As a lot of companies or countries, think of ways to tax globally based off of certain factors. What's to stop companies from saying, well, I hate this. Now I'm a Taiwanese company. Now I don't have to abide by your rules.
Yeah, that's also a very good question, and the answer is, the sales apportionment of global profit that I was describing actually addresses that, because the idea is no matter where the headquarter is, if you have customers, let's say in Germany, even if you're incorporated in Bermuda or in Ireland, no matter, as long as you sell something, a good or a service in Germany, you're going to have to pay corporate income tax in Germany proportionally to the fraction of your global profits that you make in Germany. So that's a system where the location of headquarters becomes irrelevant. The location of production of factories becomes irrelevant. The only thing that matters is whether as a consolidated group you are profitable and where your customers are located. I should stress that generally speaking, these concerns about headquarters moving to low tax places are exaggerated. So, in the US debate, people talk a lot about tax inversions. US companies that merge with a foreign company, and in the process of doing that, they move their headquarters abroad. The truth is that that's something that's relatively easy to control through appropriate regulations. And so, for instance, in 2016, the Obama administration changed the regulations regarding corporate inversions, and since then, there's been zero inversion. Trump has kept those regulations, and so since then, it's become so hard in practice to do a legally valid inversion that this just doesn't happen at all anymore.
Yeah, thanks for the lecture. Something I've always wondered about booking these profits in different countries is, if your spend is in not the tax haven country. So, the example of Alphabet, for example, if the profits are booked in Ireland, but most of your spend is in the U.S., where you have your expensive workers, a lot of your expensive equipment, all that. Like, what costs are they hitting in that exchange? I mean, obviously it's not as high as the taxes themselves, but what costs are they hitting, and what strategies do they take to avoid that transaction cost when they actually go back to spend in non-tax haven countries?
Yeah, that's a great question. So the question is about, is it if I rephrase it a little bit, is it possible to game the system where you apportion global profits based on sales? And you can imagine ways to game that. So for instance, you could imagine that Apple would sell all its iPhones to an independent third-party reseller in Ireland, which then would resell everything to the final customers in France or Germany. And if they did that, all the sales made by Apple would be to Ireland, where the corporate tax rate, let's say, is 0%, and so Apple would not pay any tax. So yes, it's not a perfect solution. The same problem happens in the U.S. state context, since most U.S. states tax corporations using that sales apportionment system, and in practice they found ways to prevent abuse. The simplest way is to say that if a company makes a big fraction of its sales to a zero tax state, like Nevada, for instance, zero corporate tax, then these sales are going to be disregarded to compute how much profits are taxable in California. And if the other part of your question is about the allocation of costs, and that's a good question. And my answer at a high level is that this system of sales apportionment is extremely simple, in the sense that we don't care where costs are incurred. The only thing that matters is how much profits you make worldwide as you report to your shareholders, and when and where your customers are. It's very simple, which is good, but which is also bad. It's in many ways too simple, and so I don't want to say that it's the magic recipe. And I think it would be better, for instance, if we kept the way that we're doing things today, but we reached an agreement, an international agreement where most countries or most big countries effectively tax their own multinationals at high minimum rates, of 25% or 30%. That would be better. What I wanted to illustrate is the idea is that even if we fail doing that, which is, in my view, the ideal answer to that question, international coordination, even if we fail to reach that ideal, it's possible to take measures which are defensive measures, which are not perfect measures, but are going to make sure that the most blatant forms of abuse are not possible anymore.